I hope founders take this one piece of advice. Please do this.
What do most founders misunderstand about this whole investment bit?
Investors are investing in businesses. The technology and the product is just one part of that.
When you see an entrepreneur coming to you for a pitch as a VC, what are you looking for?
The raw ingredients of founder talent are substantially more important to me, probably than any other variable.
If I am an aspiring entrepreneur, what are the first things I need to do to understand how to approach investment?
First things first is sort of know thyself, because I think the really important thing is to make sure that the story you tell is consistent with who you are as a person and what your strengths are.
Does it kind of like boil down to, Karl, having a fantastic business?
You're driving on this car on a journey, and the capital is the gas in the tank. That's really all it does, is it gives you time and capacity to build. But there's no doubt that the underlying operational success of the company doesn't matter who the money comes from. Over time, the talent and the product all, do win out.
Could you walk me through a pitch that was like, you know what, you just said yes to that as fast as possible? And what did that founder do that was different?
There's a couple things.
Karl Mattson has been the buyer, the builder, and now the backer. He served as CISO 4 times, worked inside startups through acquisition, and now runs Squared Circle VC. The triple lens is rare, and today we're getting into what he actually looks for, what founders consistently get wrong, and what it takes to build something that matters in cybersecurity, and not just something that sells. You've sat at both sides of the table. You've been CISO, getting pitched by vendors, and now you are the VC getting pitched by founders. The first thing I want to know is, what do most founders completely misunderstand about this whole investment bit?
Well, first of all, thank you for having me. I've been an investor as an angel investor for a few years, and now full time. I'm still learning every day, and one of the things I think is really dawned on me in this process is to remember that investors are investing in businesses. The technology and the product is just one part of that choice. And so I do believe that founders oftentimes obsess over their product differentiation, their specialists, how their product is better than their competitor, and that may be true, but that doesn't mean that they're a better business. And so I try to use the comparison of a restaurant, for example. So a Michelin star restaurant can be a good business or it could be a failure. So can McDonald's. McDonald's can be a great business, even though the food isn't as good as the Michelin star restaurant. So we have to tease apart the conversation there, because an investor is looking for a business, not necessarily the technology winning every time.
For people who don't know Karl, could you just briefly introduce yourself, Karl? That'll be nice.
Sure. So Karl Mattson, I'm the founder of Squared Circle Ventures, which is a small micro venture fund. I invest in early stage seed cybersecurity companies. And I've been doing that for about a year now, having kind of left my my CISO career. I had 2 CISO positions in financial services for several years, and then I had 2 CISO positions working for vendors, No Name Security and/or Labs. And those experiences, both in the operator side and the vendor side, gave me a really, I think, a broad perspective in terms of the marketplace of buyers, sellers, builders in cybersecurity, and I'm just thrilled now. I get to participate and be a part of a team as they're building a new company and trying to build that company into what the marketplace needs.
What's been different, like working as a CISO versus working now as a VC, and why this switch?
The switch for me, actually, on a personal level, is probably actually returning to my original career trajectory. I have a finance degree. I have an MBA. I went to business school. I actually intended this to be my career path, at least generally speaking, about 25 years ago. And I was in the military. I was about to leave. And then a thing happened called 9/11. And so I decided to raise my hand, and I re-enlisted in the Army, stayed in, and remained in a security career, even though I had sort of a business aspiration. So over the course of time, especially when I went to work in cybersecurity and banking, worked at PNC Bank, worked at City National Bank, later PennyMac, the mortgage company, I did find the business, the core business of that I was helping secure, super fascinating. And I always tried to participate in that when I could. And so for me, this was a journey, a long time coming to return to this space. So to some degree, I wasn't completely ill-prepared to be an investor. At least I have some kind of academic underpinning my transition here. Not being an engineer by background, I'm a business finance person by background. So, and then for me, the trade-off has been, the operating pace of being a CISO and leading a team is extraordinary and it's stressful. And I think now as an investor, I'm compelled to take a long-term view and to think about problems in years rather than thinking about problems in milliseconds.
Maybe let's start to slice the problem. First, what is it like getting investment? What is VC? Could you explain that first piece to people who are new to this world and just trying to build a business out there?
First and foremost, venture capital is one way of financing a business. The vast majority of businesses in the United States, including technology companies, are not financed with venture capital. Venture capital is a very small subset of how to build. So, for example, if you're building companies, you can pay for it yourself. You can go to the bank and get a loan. There's all sorts of different ways that you can build companies. Venture capital is not your only option. So first things first, what I would always challenge a founder to think about is why is venture capital specifically the thing that you need, rather than just building a product or building it with your own money or going to a bank and getting a loan. A lot of times your business model actually is not well suited for venture capital. Venture capital is a subset of sort of investments that typically the money is coming from institutions. So, for example, it might be a university endowment. Let's just pick Harvard as an example for a second. Harvard has billions and billions of dollars of an endowment, and they're putting that money to work by investing in venture capital funds. Now, that institutional investor of Harvard, I'm just using that as an example, their time horizon of expecting results is decades. Could be, or same with an insurance company. They're putting money to work, expecting it to go to work for decades. They're not looking for that money to come back to them anytime soon. So venture capital is patient, very, very, very patient money. It's deep institutional money. It is not, short-term. It is not short-term incentivized. That doesn't mean that venture capital firms don't have sharp elbows from time to time to do a business deal. But I think that's something to think about as a builder of a business. That's who the capital is coming from, and the expectations are for large scale growth over the course of a long period of time. And so that's that. I've used this analogy before, where I think of CISOs tell time with a stopwatch, vendors tell time with a calendar, quarterly, monthly calendar, and venture capital firms tell time with revolutions around the sun. And it's a very different way of looking at decision making when your decisions are intended to yield results in 10 years versus decisions really intended to yield results in 10 days. And I think that's a perspective that a founder needs for their customers, just their investors.
There's this hierarchy of people that are in VC, right? You have your LPs and GPs and operating partners and stuff like that. First of all, when you approach a VC, what is VC trying to do? And how do you understand that? Well, let's talk about that. Why are they investing? What are they expecting? And why do you even go to a VC from a perspective of an aspiring entrepreneur?
Sure. So a venture capital firm, a firm is a company, but that company establishes funds. So think of a fund as a bucket of money. And so they raise a fund, and let's just say it's $100 million fund. And that $100 million has been raised on the agreement of it has a thesis, it has a purpose. And so there's an expectation that $100 million will be used to, say, seed fund 20 companies. And so the VC firm is looking to find the founder teams, the ideas, the technologies that are the best use of that $100 million, expecting that most of the time it's going to come in, $5 million increments that they're going to deploy. And so a VC firm also typically deploys and makes those investments of $100 million. Let's say it's over the time period of maybe 3 to 4 years. expecting that the time horizon of outcomes is maybe 10 years down the road. So so if it's 3 years and it's 20 companies, a VC firm might be looking to make 7 investments per year out of that fund. And so one thing you, of course, always want to look at is like in that fund, how far along are they? How motivated are they to deploy money? Have they already deployed into a competitor? Those are some of the things that the VC investor is thinking about, is they have to responsibly use this money. They've agreed to take Harvard's money and they have to put it to use. And so when you're a founder, to know those details helps you understand what the motivations of your investor are. Why one investor was like an easy yes and the other one was like the hardest no in the world. Maybe it had nothing to do with your company. Maybe it just has to do with the fund and where they're at and how they manage things.
So essentially what you're saying is that if they want to put 5 million in you, they're expecting 5 million to be $1 billion. And that's where they will invest. Even if it is a profitable company and it's getting like, let's say, 10 million, 20 million sort of like valuation, even if it is profitable to them to invest, they would not. They look for the moonshot, which is $1 billion. Is that the philosophy that every VC has in the investment that they make?
Different VCs have a little bit of different philosophy, but I'd say let's go back to this fictional $100 million fund. They invest in 20 companies. What they're really hoping for is they're hoping for 2 or 3 like large success stories. Those 2 or 3 large success stories started off as 5 billion, and then later on they exit to the world at IPO or acquisition at 1 billion. And even having one of those probably pays for the whole fund, pays all the investors back adequately. But of course, then of those 20, 6 or 7 are going to go out of business and 6 or 7 are going to break even and 6 or 7 are going to make a little bit of money. And then 2 are going to be really fantastic outcomes. And that's what a venture investor is expecting. They are expecting there to be a significantly different outcome over the course of time. And so the think of the trade-off is that that's a very high risk pattern of investing. There is a high likelihood that the investment they make is not going to result in anything. And so because it's a high risk endeavor as an investor, they also expect there's a high return. Also, high risk, high reward. That's a venture capital mindset. But it's not high risk, high reward short term. It's high risk, high reward in measured in decades.
So when like you see an entrepreneur coming to you for a pitch, as a VC, what are you looking for?
Typically, what I'm looking for is I call it like the raw ingredients of founder talent are substantially more important to me probably than any other variable. And so an example that I would use would be let's pretend for a second that I'm the general manager of an NBA team, and my job is to draft a high quality basketball player out of college to join my team. I could look at players of all different positions and sizes and track records. But I know that in the long term, the best athletes are oftentimes they win. I want the tallest athlete, the fastest athlete, and I can coach that person up sometimes. Sometimes the 5'10" shooting guard who scores a lot of points in college maybe isn't going to be the best pro, and maybe that's not the right recipe ingredient for the long-term MBA. And so I am looking mostly at the founders and their track record of performance and the ability for me to project forward that this is a person or a team that's going to keep being successful. They have the intelligence, the track record, the reputations, all of those things. That's by far the most important thing. Then we start to get into the competitive category and product, the market opportunity, those kinds of variables. But if that raw ingredient of founder talent is not there, there's no business to be built.
Got it. But institutionally, the way you structured the way venture capital works, right, is that if you want a company to be $1 billion company, like from the investment that you're making, right, I think you want to cover all the expenses for the rest of the investment. So you're taking a bet, or you want one of them to go big, right, because you've got $100 million. So you're ideally looking for that $1 billion, right? You're ideally looking for the company to go big. So when you are like structurally looking for the whole pitch or everything, right? You're essentially trying to evaluate how can this particular company from the aspect of founder, problem statement, value proposition, competitive, everything you evaluate to just see how can this be big. That's the whole thing, right?
Yes and no. I think that the big is always a relative term, right? So, like to give you an example, it's like let's go to the extremes on this curve would be like Sequoia, Andreessen Horowitz on the extreme large side, which is yes, they don't really consider investments unless they think that there's a absolute massive company to be built out of this idea and founder team. Whereas there are investors who might be perfectly happy with a good business, a good software business, and like a couple base hits up the middle are perfectly fine for them. That's what they value as investors. Maybe they like a little bit more predictability. So yes, investors have different capacities for what they're looking
Got it.
for.
So you're saying the risk-taking ability and the evaluation criteria change from the tier investors? Like
Not
tier
necessarily-
one would look for something else versus tier two, tier
Not
three.
necessarily tier, but like let's I'd say it's each fund. So if a firm has funds, and that any firm has usually multiple funds over the course of time, every fund has a thesis. Think of a fund as that bucket of dollars has a mission. And that mission is seed stage cyber, blah, blah, blah. Now they might have a bucket right next to it that's late stage company, pre-IPO cyber. Great. That bucket has a very different mission. And so they're going to deploy that bucket of money with the expectations and criteria specifically designed for that bucket of money. And so large firms have many different buckets that serve many different purposes of expectations. So it isn't the case necessarily that it's not just Sequoia on the one end, because all large firms have a diversity of missions that they're performing at the same time. They're just looking for like an aggregate excellent return. So in that sense, I think that there's we could overgeneralize a little bit probably. Even some of the specialty cyber funds have seed, opportunity, secondary funds that are they're purposed for different things.
Again, like I'm glad that we got this out, because this is where I see a lot of founders making mistakes, right? Like they often think that a good pitch, a good team, a good value proposition, and would like there's no like I would say percentage of getting a no from somebody, right? So it doesn't really depend only on the things that they do, but it also depends on finding the right people to work with. I think like understanding who you're approaching and what they're looking for, what their thesis is at different tiers or at different places differs, right?
Yep.
It's not just one size fits all ideology that kind of works when you approach a VC. Is that true?
Yeah, I go back to this restaurant analogy because I think it really holds water. If you have an idea for a restaurant and you're a fantastic chef, and you pitch an investor, but that investor is looking for fast food chains, and they say no, big deal. Who cares? They're a fast food investor. You're a Michelin star chef. You're not compatible in terms of what your mission is. That's perfectly fine. And so what you really want to find is the restaurant you're building, there are investors who are looking for your style of company. And that doesn't necessarily mean that they're bigger or smaller or everything like that. They just have a different pattern they're looking for.
So if I am an aspiring entrepreneur, what are the first 2 or 3 things that I need to do to essentially understand how to approach investment?
First things first is sort of know thyself. I think it is difficult sometimes for a founder to look in the mirror and know what their flaws are and their strengths are, honestly. So if I told you, Prasen, that I am absolutely determined to join the MBA, I'm 48 years old and I'm 5'7". Like, it's not happening, right? And it doesn't matter how much you coach me or how much grit I have or what my desire is, or even if I'm a great shooter, I am not making it in the MBA. And so I think but my feelings aren't hurt because you tell me, hey, Karl, you're not really fit for the MBA. Guess what? I'm not fit. So founder first has to diagnose themselves and say, really, what are my strengths? Am I ready for this? Do I have the founder team I need? Am I in the eyes of someone else, am I an adequate person to build the business or the type of business? Do I fit the product? Do I fit the market? So that definitely helps me think too about how you pitch the company and how you pitch yourself, because you really have to understand what your audience, how your audience is going to view you, and make sure that you design your vision accordingly. Because I think that the really important thing is to make sure that the story you tell is consistent with who you are as a person and what your strengths are. If I tell you that I'm the best offensive pen tester in the world as my skill set, but then I pitch you on building a restaurant, like that's a very poor fit. And so I think that there's the road testing your pitch with people who can be very honest with you. The feedback: how's your story landing? Is this credible? Are you a credible storyteller in this regard? That's super important to road test that. I think that it's hard for founders to find truly honest feedback about how realistic their chances are.
Yeah, I think let's maybe get to the specifics, right? I think let's talk from only pre-seed and seed. I think the later stages are a little more mature, and you have people who can help you with those things as you get into the funnel of funding, right?
Yep.
But people now, as an aspiring entrepreneur or an entrepreneur who's built something with certain idea, they've got a decent business, whether revenue or not, whether a big team or not, whether the value proposition or not, but they've got something going, right? And now they need money to go from that stage to the next stage. When they now approach a VC, should first of all they approach a VC? That's the question. And if they do, what are the things now that they need to look for in order to go towards either the right VC or the right funding mechanism? Let's talk about that. What should a founder do at this point in time?
Yeah, I think this is important. An important part of self-diagnosis, which is as a potential CEO of a company, if you don't have a network of people already who are willing to go to bat for you and make introductions, this is not a good place to. You're not in a good starting spot. Honestly, if you have to cold call venture investors and send in decks to an investor who's never heard of you and has no reference for you, you're immediately have two strikes against you. But if you have a good network, and if you've been an employee, especially a product manager at a successful company, you have CEOs that you've worked for in the past, or investors who know who you are from your last company, those people going to bat for you, kind of one-on-one back channel. That's the signal that you're going to get high quality meetings. You're going to get a very good chance of an open mind and an open opportunity. So I think that if a founder is fighting with cold calls, that's really a tough place to start. I don't admire that. I don't see that as a recipe for like investment success. Unless you've got a lot of revenue coming in, which is a different story.
Does it kind of boil down to, Karl, having a fantastic business? Or is raising money different than just creating a good business?
I think it's a great question, but I might frame it in a way of you're driving on this car on a journey, and the capital is the gas in the tank. And so if you have a bigger, fuller gas tank, you'll have more opportunity to get to the destination, but it doesn't guarantee anything. It just gives you a little bit. It gives you more swings at the plate, more miles in the car to go. That's really all it does. Is it gives you time to build and capacity to build. But there's no doubt that the underlying sort of operational success of the company is kind of, it doesn't matter who the money comes from, or over time the talent of the product do win out.
That makes sense. Okay, could you walk me through a pitch that was like, you know what, you just said yes to that as fast as possible?
Yep.
And what did that founder do that was different?
There's a couple of things that there's a couple of presentations that I remember very vividly. The first time I saw them, within like 5 minutes, I'm like, this is the easiest yes in the world. And it starts with the message that, number one, is there's a very, very crystal clear vision of the future. And then two, that I, as a founder, am sort of uniquely able to deliver on that future in a way that no one else can. So here's the best example, and I hope he doesn't mind me sharing this because I'm such a huge fan of Dan Amiga and the team at Island. Right off the gate, what Island's vision was the future of work, the future workplace being device and location agnostic. That messaging was crystal clear the first day that company was formed. And why are they the team to build it? Well, because they've been doing enterprise browsers and sort of remote access time after time after time. done. You've got a crystal clear vision. You've got a team that was put together with a talent very specific to delivering on that vision. And that's what else can you ask for? That's a great recipe to start with, is that kind of track record and that kind of clarity. So I think that track record and clarity are rare, because the reality is the market will tell you every day what features and benefits and bugs and roadmap items you need, but you're not going to have those on day one. So I'm not really going to look at your features necessarily. I don't really care what feature you have on day one. I care what features you have in place in year 5. And if you're a team that credibly delivers on good product and good features over the time, not that your features are comparatively differentiated the first day.
I think there's a lot of underlying skills which are more granular as you need when you approach, build, pitch, practice, look through the other details of the rounds and stuff, right? That you need to learn. And there are many ways people can learn this, right? What do you think are the best ways for someone who's new to the space of raising? Where would they consume this information and this experience from the best?
It's a great question. I think it's still kind of an area of tribal knowledge, which is unless you have a founder who's maybe gone through this process before and who's willing to either allow you the benefit of their experience and get true mentorship, or you are maybe you're the member of an executive team that was a startup. You're not the founder, but you're the member of the executive team, where you get to kind of like a ringside seat to watch this process unfold behind the scenes. It is very hard to get that experience and to know what's happening. I'll even say for myself, I was at No Name for 3 years. I'm on the executive team. I report to the CEO, and I had just a wealth of information every day that was brand new and fascinating about how this industry works. Yet at the same time, I still am every day picking up things. So I think good mentorship is super important. Yes, there are books on Amazon, but that doesn't matter. Honestly, I don't think the books matter as much as just getting in the room.
How would you find the mentors?
Oh, I think repeat founders or exited founders are oftentimes thrilled to be coaches and mentors. That's a very, let's call it reasonably successful exited CEOs.
Mm-hmm.
That's a very, very small, specific group of people who I think oftentimes have a great deal of opportunity to bond together. I have one person in my network who's a CEO for a startup all the way through IPO. And now he's kind of semi-retired, and his whole life is just mentoring other CEOs now. I think people who go through that journey very much it's rewarding for them to share that knowledge to other members of the tribe. And I think that's a great thing to reach out, and don't hesitate to ask an exited CEO to be a mentor.
Are VCs good mentors?
I think there's a significant number of VC investors used to be operators. They used to be startup founders. So I do think that those founders, those investors, have an empathy for what it's like to sit in that chair. That's incredibly useful for mentorship. Others maybe are more financial engineers, less so than operators, and you need those too. But yeah, I think a lot of investors, and I think the investors that I know personally at the top firms in the world, those people were all operators. They were CEOs and product managers at successful companies, and I think that their level of empathy with the CEO's journey is very present.
Got it. That makes a lot of sense. Okay, so we've covered a lot of pre-do's for approaching a VC or understanding the realm and about that. Now let's get to the actual pitch, right? When someone comes to pitch and is pitching you through, what are the things that are running in your head as they're going through all of the stuff?
First and foremost, I aspire not to trust myself. I actually I always like to not overreact in the moment, because either I like something or I don't, and I kind of know right away, but I try not to say anything. I try to take notes. I want to be diligent. I want to be thoughtful. And I really, really, really try to let my opinion marinate overnight in my head before I put it out on paper and spit it out back to somebody. I do think that's for me useful to not necessarily overreact in the moment. Ask a lot of questions, take a lot of notes, and let those sort of ideas compile. Things look differently in the morning than they do in the meeting, and I think that's an important thing to remember as an investor is to just extract as much information as you possibly can without expressing opinion. So that I'm looking to pick at every possible part of this business model that I'm being proposed as to what details do I want to know going away from this.
What signals one would pick as the guy who's pitching from the panel or the VC, right, that it is going in the right direction versus the wrong direction?
I wouldn't read too much into that. I think that there's a tendency to believe that you can read the room, not over Zoom. I don't think that if you're in person, different story. If you're in person and you feel the vibe is awful, it's probably awful, right? Over Zoom, though, I think that we're like, you and I, our success rate at actually knowing what the other person's thinking over Zoom is very low. So
Got it.
I wouldn't be overdoing that, because the truth is investor at massive tier 1 firm over here. Truth is, got a baby 6 feet away that you can't see, and that baby's just about to wake up, and so you lost their attention for a minute. But hey, that's just life, and so I don't trust that over Zoom. That's my opinion.
There are different stages of, like, I would say, meetings with a VC, right? What are you expecting from all of these different stages or calls that we have with a firm, starting from the first until you have like closed end to end? And what should you expect as a founder from this or that?
Yeah, I think there's a lot to learn about the investment process, looking a lot like the buyer process as well. So we always think about like, who's your buyer for a security technology? Everybody focuses on the CISO, blah, blah, blah. But the reality is back in that CISO's organization, there's a whole group of stakeholders that need to be on board with whatever that decision is. It's the engineering team and the finances have to be there, and there have to be stakeholders agreeing with the CISO that that's a good idea. The same is true with a VC firm. Yes, you're meeting with this investor and you're going through this, but their due diligence is going to include their lawyers, their finance people, the other partners. You'll probably be asked to pitch over and over again. So think of the VC firm like you would selling a complicated enterprise sale. There's a lot of stakeholders that have to be convinced, and those stakeholders all have a job to look at the question from a different angle, to weigh in on it, to do their due diligence. And so just to expect that to take time, and expect ultimately then the final decision to take place in a meeting that you're not in, a committee that does a vote that you're not involved in. You'll know the outcome, but yes, there's usually a general partner or a managing partner that kind of makes as like the final vote, but a big VC firm has a lot of people involved.
Got it. So you are going to meet with a lot of people. You'll first be evaluated at the level of like, hey, whether this makes sense or not in the first pitch. Second is maybe more technical. The third one is like, sure, now we get it. Now tell us more about like your business. And that's where maybe the IC comes into place, like the investment committee, and they say yes or no. Is that how?
That's right. Here, I hope founders take this one piece of advice. Please do this. Go to ChatGPT or Gemini or Claude, pick your model, but go on there and design prompts that evaluate your pitch from the perspective of finance officer, legal, compliance, investor, customer, etc. Red team your pitch. And you will find that there's an enormous amount of things that come out of that, especially if you do like a legal review. Like have a legal red team, like upload your pitch to Gemini and ask it to do a legal red team. Holy cow. You will find out most of what a real lawyer is going to find out very quickly. So I do highly encourage that as a fantastic use case of the kind of the frontier models at red teaming a pitch deck.
Oh, that's actually like a really good idea. I think people may do that with their general prompt, like how would a VC evaluate? But I think you give a really good perspective of like there are different stakeholders in a firm, when you do the investments. I think you should do it from all of those angles because in the end, they will all play a significant part in the voting.
Totally. And I'll even add one more. The very first thing you should do is prompt the model to output to you what is their due diligence checklist going to be. All right, and it'll prompt back to you. Here's 47 things that are typical of a. Now you have a roadmap of how you can grade yourself as am I ready to go withstand this due diligence. And I know that this is imperfect. Don't get me wrong. It's only going to get you 70% there, but you can get a really hot read on something that you maybe clearly are missing on. Hey, you really are missing on insurance coverage or stuff like that. It's easy to fix.
Got it. What are the top few things that people should keep in mind for due diligence, like in general, like from your perspective?
Good attorneys pay for themselves 10 times over. I think that there's they like legal representation at the formation of the company. Go big. Go big. Like go pay for a good attorney. Don't go to a discount because that essentially sets you up on a pedestal to do well, to withstand the scrutiny at sea, but also in the future. So that's the one thing I'd say is like you can't do this as a founder by yourself. You're an engineer, or you're a product manager, or you're a security person. Awesome. Just go get a good lawyer. That's the only way to do this with a level of confidence that you're going to pass due diligence.
So you don't advise people like entrepreneurs who are not putting in a lot of money to begin with to use Clerky or platforms like that to form their companies?
I don't know. I've never used a platform like that though, but I would, the vast majority of the companies that I interact with, their law firms, it's Gunderson, or it's Morgan Lewis, or it's Maitar in Israel. I don't see the top companies being formed with anything other than top legal firm representation. And I think there's a reason for that.
Let's switch like the gears towards security a little bit and talk about that. What are some of the things that one should like know about security investments specifically as like a young entrepreneur or like just about to raise kind of person?
I think one really important part is to know the competitive landscape that you're about to enter. I do actually think it's pretty rare that founders come in with a very nuanced or sophisticated view of their competitive landscape. I think that's actually unusual. I always use the example of like a company that's like in data security, and maybe they're going to move into the category, and they think that their competitors are all these other startups, and no, companies like IBM and Microsoft sell 100 times more software and data security than most specialty companies. So I think that a very realistic viewpoint on the competitive landscape is super important and rare in cyber, because I don't think founders oftentimes have a great read on how the mass market actually buys, or what do they actually buy. In a lot of cases, the competition is nothing, which is, and that's true. There's sometimes there isn't a competitor other than it's expensive and people don't do it. So be open to really understanding your competition, and the competition. If you think your competition is the startups to your right and left, then you do not understand your competitive landscape.
Got it. What's different in security though than other verticals, like investment wise?
I think a key difference, and fintech is a great example, is that the cybersecurity go-to-market motion is unique. There are not many security companies who've ever been built on a model that's download a free trial for 7 days and then pay with a credit card. That's just not how cybersecurity companies are usually built. Yep, there's a couple exceptions, but for the most part, we're talking about companies that are built on business-to-business, large enterprise deals. If you go over to fintech, now we're talking about mobile apps, right? Consumer technologies that maybe there's high volume, low margins, or low price points, and so I'm overgeneralizing because a lot of fintech, of course, is infrastructure too. But my point is that cybersecurity's go-to-market motion is unusual, and so I think that as an investor, I really need to see that first of all, the founders understand the market buying behavior that they're entering, because it's unique. If they're not ready to, they need to know what they're getting themselves into, because it doesn't look like fintech. And then on the economic side, I think that we're talking about an investor in that kind of the cyber sort of model is looking for just even like a handful of indicators that large enterprises are on board is kind of good enough to fund
Mhm.
and keep going. If you're in the fintech side, like 3 customers, this doesn't cut it. Like that's not going to happen.
Yeah,
You have to have more customers. You have to have like a greater market penetration to separate me from my money.
that makes a lot of sense. Also, is the difference, Carl, the way like usually cyber companies like reach an exit? Like for instance, not like the percentage of a cyber company like raising to exiting at IPO is a lot lesser than other verticals. Do you think so? And is that the difference of like how investors now look at you from a different angle, that they probably don't expect you to go IPO with a particular value proposition, but they're looking for a larger exit. And now the difference between their go-to market or their overall value proposition is evaluated differently in cyber investment process?
I think that might be overthinking a little bit because I don't really to a great degree of technology companies. I don't think that cybersecurity is anything other than kind of like a typical. Hey, companies are having the IPO pipeline is moving very slowly. It's not just cyber; it's everybody. Everybody is kind of beholden to that. But what cyber companies and investors know is that the cyber revenue streams are a little stickier because they're bigger. They're bigger deals. They're harder switching costs than a lot of like commodity or not commodity commercial technologies, consumer technologies. So probably the cyber companies are a hair less volatile. They're just a little bit more predictable in the revenue streams, I think, than average tech companies. But overall, I don't think that the marketplace is substantially different. I mean, every vertical has its cadence, and
Mhm.
cyber is a vertical. So
That makes sense. That makes sense. Where should one build right now in cyber, according to you? You've seen like so many pitches. What's the take on the market in cyber right now?
I mean, I think there's what everyone's doing. There's what everyone's doing, and that's what people should do. What everyone's doing is building out technologies either capitalize on or defend against agentic AI. Right? Cool.
Yeah,
So investors, I think that's kind of a commodity, or that's a um, short-term way of looking at things. Because I do think that for me, I think that the differentiators in the long run, or the companies that win, are not going to be different in terms of like their agentic AI something. It'll be more about like their distribution channel, how they sell, how they execute, how they operate. So I think the operational excellence of a company is actually going to become a lot more important because the products will start to look similar very quickly. Like for example, you're in a competitive category and your competition comes out with a new feature. That's awesome. How long does it take you to catch up and build that feature? Well, before that was 9 months. Now it's 9 days. Okay, I've shortened the distance of time that it takes me to have product parity. Now the differentiator is pricing and execution. And so I think pricing and execution matter more in the future than they do today.
makes so much sense. Any other advice for cyber founders right now who are raising?
Advice for cyber founders. First of all, I think that what I'm seeing so far is that if you don't get as like a seed funding pretty quickly in your process of raising money, if you don't get it pretty quickly, you're not going to get it. And so probably I would advise companies to if you got through 20 investors and you haven't had a term sheet, it's time to turn that process off.
I
Because what
see.
will happen is if you keep pressing on it, you'll end up having a reputation as the company that didn't get funded, and then you're never going to get funded. So probably I would have a quick trigger about pulling the plug in that process, diagnosing why you're not getting funded, go back and re-engineer, and almost every time I would suggest the elixir to fixing that is the founder team composition. Hey, maybe you just don't have enough capacity in the founder team. Maybe you need a CPO with a really awesome product management background. Maybe you also need some founder teams can be 4 or 5 people. Maybe
Mm,
that's the thing because the 2 founder team maybe isn't deep enough. They're not good enough not good enough is the wrong word, but like maybe they're not complete enough. Maybe it is time to bring in a third or fourth founder. I think that's the kind of thing that I'd be thinking about if I didn't get a yes right away, is to go back, re-engineer this, go back to the sounding board about why isn't this happening? Just don't keep pressing on the pitches until you've re-engineered it.
Maybe a couple of last questions, Carl. I think this was, first of all, really fantastic to get your perspective on investment. I think people must have learned a lot about how to even view the VC landscape, then how to sort of approach a VC landscape, some things to keep in mind as you're pitching, and of course, some of the cyber polls that you've dropped, right? Those are really fantastic as well. Let's give some practical advice to people now that are in the cyberspace. And like, if you were to then tell someone that, hey, you know what, this is where the market is headed, and this is what you should do in the next year or so, and this is how you should start. If you were to give someone that practical advice based on the market composition that you see right now versus where it's headed and how people should look at it, what would that look like for specifically cyber founders at this point in time?
I think right now I think of the teams that are being formed, that are creating new companies, are embarrassingly talented. It's stunning to me. I think even compared to 5 years ago, the track records, the education levels, the engineering capacity on the average founder team today is just higher than it was before. So first thing I'd be thinking about is do I have I touched in my career as a founder, have I touched all those keystones to be competitive? And I think in a lot of cases, the real answer is to go back and spend some more time on a reputable product team. Companies like a Demisto or a Torque or a Splunk or Wiz, being on those product teams, and increasing the resume quality in that way is super important right now. I just don't think that founders are going to get funded quite as easily unless they've got truly special backgrounds.
Got it. Awesome. Where can people reach out to you and learn about Squared Circle?
Well, it's just me. I'm the only one. So LinkedIn is about it. I guess I'm relatively active, and that's my only kind of like my only storefront, if you will, as an investor or as a professional, is LinkedIn. So please do feel free to drop me a connect request or message. I'm on there probably more than I should be.
Got it. And what are some good things and bad things people do when they reach out to you right now that you like versus you don't like?
Yeah, just the first message being a pitch probably is not gonna get anybody anywhere. Whether you're selling me staffing services or even if it's a cybersecurity company, I think that make an attempt to create a connection or a relationship first. That's meaningful, and it's hard to do that on LinkedIn, I know. But the other part would be like, don't drop me your PDFs and documents, your pitch deck via LinkedIn messaging, because if you're dropping your pitch deck to me via PDF on LinkedIn, that what I know is that you've gone through a lot of investors to get to that day. That's not a good thing.
Got it. Okay, awesome, Karl. I think this was really fantastic, especially for me. As an entrepreneur, I learned a lot from this episode. I've always gotten so much clarity from the session that we've had. So thank you for everything. Thank you for this particular episode as well. I'm sure the audience has loved listening to all of the different perspectives that you've given on each of the phase, how to approach a VC. I'm sure you'll get a lot of messages after, but thank you for your time, and really, really glad to have you here, and see you soon.
Thanks, Prasen.
If you are a builder in cybersecurity or a CISO thinking about becoming one, the through line from this conversation is pretty clear. The market doesn't reward just cleverness, it rewards specificity. Know exactly what you're solving for. Get them to pay before you optimize anything else. And stop trying to impress people who haven't really felt the problem. Karl, thanks for being honest about all of it. Links to Squared Circle VC and how to reach Karl are in the show notes. Thank you so much, everyone. See you all in the next episode. Until then, have a good one.